Good afternoon. Happy Friday, June the 9th. Mark Milam here, your mortgage professional. Quick hitter for you today, just to give you an update. Relatively tepid week in the mortgage-backed securities market. That was thanks to the absence of economic data and also the fact that the Federal Reserve members have been in a lockdown period where they don't make public comments, thank goodness. So Monday through Friday of this week, really not a lot of mortgage interest rate movement. We're finishing out the week in a same trajectory, same narrow range as we started the week. That will likely change as we move into next week. We'll talk about that in a minute. If we take a look at mortgage-backed securities, you can see here over the past 5 business days, very narrow trading range. We did get a little piece of good news. Sounds strange to call this good news, but back on June the 8th here, we noted that initial weekly jobless claims coming in at 261,000. That's against an estimate of 235,000. First time in my career we've ever really celebrated higher than anticipated joblessness. But that's exactly what our Federal Reserve has told us they want to see. Whether we agree with it or not, the Fed has explicitly stated they want a job loss recession akin to the recession that we saw back in the 70s and 80s. That's their recipe. That's their formula for putting inflation back in the bottle. And while we don't necessarily agree that that is a mandate, that is what they've told us. And so that's what we've got our eyes on. As such, this number coming in a little hotter than expectation for weekly jobless claims is good news on the inflation front. Hopefully it will mean an easing from the Fed, although it's just one report, of course. What we're really watching is what's going to happen next week. Next week is going to be the polar opposite of this week. If this week was the calm, next week is the storm. Monday, nothing scheduled, but Tuesday, a very big day where we get the Consumer Price Index. That's the most widely regarded measure of inflation. We're going to be looking at the overall year-over-year number, of course, hoping that we continue to see that decline as it has very smartly over the first 5 months of the year. We're also going to be watching for the core number where we strip out food and energy. And then lastly, we're going to be looking at the month-over-month numbers there with the CPI. Lots of data in there, and it's going to be very impactful because the very next day, we're going to get the Fed rate decision, the Fed meeting in a regularly scheduled session on Tuesday and Wednesday of next week with the policy statement coming 2 p.m. Eastern time on Wednesday. Right now, about a 27% chance amongst futures traders that the Fed is going to hike the Fed funds rate yet another 1/4 of a point. Majority of traders out there thinking that the Fed is going to hold steady, keep interest rates exactly where they are, and give it a little bit more time to see how the economy unwinds. We think the CPI number on Tuesday is going to be a big factor in determining what the Fed does on Wednesday. Additionally, on Wednesday, flip the screen back around, we're going to get the PPI. That's the Producer Price Index. That's coming in. That's yet another measure of inflation, and the fun doesn't stop there. Thursday, June 15th, we get another initial jobless claims number. We get retail sales. We're going to get some production numbers here, and then finally consumer sentiment on Friday. No shortage of data to dig our teeth into next week. We can see here with future traders right now at 27.6% chance of a 1/4 point rate increase from the Fed. That's about the same as it was yesterday and maybe just a touch higher than where we were 1 week ago. If I can be of any service to you over the weekend, don't hesitate to reach out, mark.milam@highlandmtg.com. Have a good weekend, everybody.